Kick us off then with what we're seeing the A shares, the CSI 300, as was said, we were discussing with David there, seeing something of a breakout. I don't know if you categorize it as that. Are we seeing a rebound that can be sustained here?
Yeah, I think so, because with the 1Q fund data that's coming together for the onshore mutual funds, it's more clear as to what happened in Q1 with the big equity sell-off. Quarter over quarter, we saw about 13% increase in the money market fund balance by about $1 trillion. Only a few periods saw that since 2015. That was the third quarter of 2015, yeah. And then last year in 1Q, and then 2Q, 3Q in 2017. So really, it's less about monetary policy neutralization, but funds moving places, yeah, changing the allocation. So that's why the fixed income market onshore wasn't that worried based on how it's trading on the policy changes. But the equities responded to the allocation change. And then also another direct trigger is the onshore fund sales had fluctuated, had a spike in January.
Okay, so how have you at UBS been adjusting your portfolio then?
Yeah, so we had cautioned investors in December of last year. So clearly didn't get the benefit of the January surge. Yeah, that's when the onshore mutual fund 1 month raised 57 billion vis-a-vis 25 billion the previous 4 months. But at the end of March, we trimmed the cash, we trimmed value, and trimmed defensive, and more moved into core growth and growth cyclicals. We also cut back on just pure traditional cyclicals. So I think with that positioning, it should be good for the second quarter as confidence resumes about this balanced growth and then the liquidity picture onshore. And in particular, earnings are really good. We're seeing very good earnings coming out of CSI 300, MSCI, CSI 500, and MSCI is still in the midst of reporting, but that should be in line with consensus. Yeah.
And earnings growth, just to add to that, Wendy, is expected to be double digits, obviously, and still quite good. I guess the question is, do earnings matter now?
They've always mattered historically, and I think because there's an outside move in the onshore market, it took a little while to figure out what went on, and I think what really went on was funds preemptively sold, but that fund is now in cash, and cash is not going to produce tremendous earnings growth. So if we look at CSI 300, 500, they reported 35% year-over-year growth and 98% year-over-year growth in 1Q. And their full-year consensus is at 20.5 and 57. Yeah.
Yeah, that's quite steep. So in terms of sector exposure then, what will be your most overweight right now, given all that information we just laid out?
Yeah, we got 3 sectors where we are most overweight. One is materials, so this is chemicals, yeah, and some, cyclical related materials in the base metal area. And then, but it's more chemicals. And the second one is industrial automation with aging population. We're definitely going to see more automation. And then consumer discretionary, where we like the small home appliances. And I think they've been hurt because people were wondering if the more material costs are going to be going too high. But I think with that coming off a bit, they should also benefit. But really, it's about consumer demand, wanting to feather their homes, and then also fast product innovation and new product launches, and then spreading into global markets. So those are the 3 areas where we are overweight: materials, machinery, industrials, and then consumer discretionary. Where we are underweight are internet and banks.
Okay, you touched on the higher raw material costs. What is the margin impact, and to what extent can these companies pass that cost on to the end price?
I think that's a question that people are quite focused on, and I think whether the inflation is structural, right, and whether this only hurts a few segments. And I think the early assessment we have is that some of the auto OEMs, machinery companies, equipment companies, and also home appliances may be facing higher cost pressure, but then equally efficiency gains and then faster in product introduction in some of these product categories and price hike can help them stabilize margins, but there will be some margin pressure. Yeah.
Wendy, final question. On an index level, and given that you are underweight some of the bigger or the biggest parts of this market, whether that's internet or consumer, do you think there's a high probability that we have seen the peak of the index already?
For the year,
Yep.
I think that's, I hope not, because I think we still have quite a bit of money on the sideline. And then I think the global picture is one of continued recovery, but not a fast recovery. So, we look at the onshore bond market, it is not pricing in PPI going into CPI, hence forcing the central bank to tighten. So we're in a pretty favorable period of the market. What I do highlight as a risk for later this year, but not in this quarter particular, is China's Directive Number 5 that was issued in April. And technically that's paved the way for a potential first case default in LGFV. So earnings are good, liquidity is not a problem. So I think the stock should go higher, but we do have some structural regulation risk still for internet, and then likely more risk on the credit front.